In this lesson, I'll explain what the financial markets are, how they function, and how we value the different markets. I'll also be addressing regulations of the markets, and will introduce briefly the different services we can receive. The importance of this lesson is that it introduces you to the financial markets to get a proper understanding of what they are and how they function before we get into more specific details. So let's get started. Markets. The definition of a market is that it is a place where you can buy and sell certain products or services. Financial markets are markets where we can buy and sell financial instruments or the asset classes we've mentioned in Lesson 2. The global financial markets are usually divided into developed markets like the US, Europe, and Canada, emerging markets like the BRICS, frontier markets, which are smaller markets such as some sub-Saharan African markets, for example. These categories usually reflect the economic stages of the countries as well as how large their financial markets are. The market is a very general term, but when we start talking about more specific places where the actual buying and selling takes place, then we are talking about an exchange. Let's look at some of the different financial markets first before talking about exchanges. Equities. The equity markets are markets where company shares are traded. The way company shares end up being traded is that they get listed on an exchange. We'll explain what an exchange is shortly, but for now, this means that the shares are available in the market for anyone to buy or sell. Once the shares are available in the markets, they become publicly traded, hence the term public company, which means that the company's shares can be traded on public exchanges. The reason a company would want their shares to be traded publicly is to raise funds from the public. When a company needs money, it has the option of either getting investors in or borrow money. When a company gets big enough or needs large amounts of funding, getting public funding is sometimes one of the main options they have. The way they do this is by issuing shares to the public in an initial public offering, which is also known as an IPO. They set a price per share according to valuation done by their advisors, and everyone is able to see such documents to decide whether they want to invest in the company. The company then gets the money of the investors who participate in the IPO, and then the shares that are owned by those who bought them are available to be traded in the market. So the company only gets the money when they sell their shares in an IPO. There are other times a company can use traded shares in the markets, but we'll talk about this later in the course and not now. For now, let's just stick to the idea that a company gets the money once in an IPO. Once the shares start trading, their price is then a reflection of how much the markets are estimating the value of the company is worth, but this usually doesn't have a direct effect on the company's actual operations or financials. The market value of a company is therefore the price per share multiplied by the total number of issued shares, and that total value is also known as the market cap of the company. This market cap is basically the value the market says this company is worth according to what people think of it at any given moment. According to the market cap, we categorize equities into their relative sizes. So we have the large caps, mid caps, and penny stocks. Large caps are the largest corporations in a country, which are usually worth in the high billions, while the other end of the spectrum, the penny stocks, have the smallest market caps. We will talk a bit more about the different dynamics of the different sizes later when we get into investing and trading in equities. Liquidity is another term that is important to know when we look at any market, especially in equities. Liquidity is usually mentioned about how much of the company's stock is traded regularly in the markets. The more liquid a stock means that it regularly trades a high number of shares or high volume. More liquid stocks are easier to buy and sell in large quantities without affecting the prices because there is usually enough supply and demand, making them less prone to manipulation or volatility. On the other hand, less liquid stocks do not have enough shares being traded regularly, which means that any change in demand or supply that is out of the ordinary would drive share prices to move more significantly than normal. Again, we will talk about this in more detail later in the course. Commodities. The commodities markets are probably the oldest, where physical commodities are bought and sold. This is where large corporations and even countries would buy and sell anything from oil to sugar, paper, or even flowers. Since none of us here would normally be interested in buying a physical oil barrel, for example, what we're usually interested in are the contracts to buy and sell the commodities and not the commodities themselves. We will talk later in more detail about how we invest and trade in commodities, or rather the commodity contracts, also making sure we don't end up with a few barrels of crude oil or a bushel of wheat turning up on our doorstep. Fixed income. Like in equities, fixed income instruments such as bonds, once they're issued, the issuing entity is no longer involved in how much the instrument itself is worth. Let's talk about bonds here just to explain this quickly. When a bond is issued, it means that the entity is borrowing money rather than taking in investors like with equities. And they are, again, doing this by issuing it to the public. A bond would normally have a coupon, which means the interest rate the entity is paying regularly to the bondholder. The reason it is called a coupon goes back to the first physical paper bonds, which had a little tab or a coupon that was cut out every time the interest payment was made. A bondholder would normally get their regular interest payments until the bond expires, then they get their principal amount back as well. How interest rates are usually decided in the start depends on the credit rating of the issuing entity. A sovereign bond which is issued by a government is usually safer than a bond issued by an unknown company with weak financials. This also means that the safer option usually returns less interest because it has less risk associated with it. Then we can compare one country's bonds to another by each country's credit rating. All these credit ratings are normally issued by credit rating agencies. The most famous ones are Standard & Poor's, Moody's, and Fitch. Once the bonds start trading, like in equities, their value reflects what the markets think of them at any given moment. Bond prices usually go up when there is more uncertainty in the economy and people want safer places to put their money, and they might become cheaper when there is more confidence in higher growth. We will talk more about fixed income later in the course when we get to building portfolios. Forex. As we've mentioned in Lesson 2, Forex is simply the exchange rate between two currencies. The exchange rates are therefore dependent on two forces which reflect the economic forces moving each currency's value independently. This is a rather simplistic way of explaining this, but this is not a course in economics, so we'll keep it at that. We'll talk later in the course about how we can measure potential changes in currencies when we talk about Forex trading. Exchange. An exchange is the actual place where the transaction between the buyer and the seller happens. Think about it like the Amazon, eBay, or Alibaba of financial assets, where buyers and sellers find each other to make the exchange. The way buyers and sellers find each other is by showing their bid and ask prices respectively. The bid price is how much a buyer is willing to pay to buy the asset, while the ask price is how much a seller wants for what they're selling. Potential buyers would then look at all the list of asks and decide whether they want to buy these or not. Potential sellers look at the bids to see whether they would sell at these levels. Some of the most known equity exchanges include the New York Stock Exchange and the Nasdaq in the US, the London Stock Exchange in the UK, and the Frankfurt Stock Exchange in Germany. And this is me at the Frankfurt Stock Exchange in 2011. For commodities, a couple of the biggest exchanges are the Chicago Mercantile Exchange and the London Commodity Exchange. Normally, transactions happening on these exchanges would be available for the public to see. We can also see the order book, which is all the bids and asks of a specific instrument. We will talk about order books later in the course when we get into trading. Now, let's look at some other exchange-related subjects which are not usually talked about, but I believe are important for you to know. Alternative exchanges or dark pools. There are some private exchanges which are also known as dark pools. There is only a handful of these private exchanges, and they are only available to some of the largest investors. Dark pool transactions are not known to the markets until they actually happen, so no one outside them can see the bids and the asks or the sizes of the transactions. The main purpose of the dark pools is for large institutions to buy and sell their holdings in bulk without affecting the general market price. There is a lot of controversy regarding dark pools, especially that they are not regulated, but we are not going to go into this here. You can see details of dark pool transactions after they happen, and this is one of the sites that we can do this for free. Dual listings and depository receipts. Although not very usual, companies can choose to be listed on more than one exchange. This is what we call dual listing. One reason a company may want to be dually listed is that its business and shareholders exist in both countries equally, and they might want to maintain their presence in both countries. Dual listing is a rather complex arrangement, which is why it is not very common. Another way that is more common for company shares to be traded in several countries is through what is called depository receipts. These are some of the company's shares that are deposited in a foreign exchange for trading. The most common are ADRs or American Depository Receipts and GDRs or Global Depository Receipts. The difference between the two is that ADRs are only available in the US, while GDRs are available in multiple foreign exchanges, mainly London and New York. For example, if we take companies like Alibaba or NIO, which are both Chinese listed companies, what we normally trade are these companies' ADRs, which are listed in the US. This way, we can have access to these Chinese company shares in the US, trading them in US dollar. Side note, arbitrage. ADRs, GDRs, and dual listed shares, since they are shares of the same company but using different currencies, they sometimes have a difference in value for a short period of time until exchange rates adjust. For some of the large traders who have access to multiple markets and through specialized brokers, there can be some arbitrage opportunities due to these discrepancies. Buying in one country and selling the same shares in another can be done to make gains just from the difference in value due to the exchange rates. This is a rather specialized way to trade and requires specialist brokers, so it is unlikely for you to come across it, but I thought it was also important to note it since we're talking about depository receipts. OTC. Another side note to the subject of transactions is about another way of executing transactions outside an exchange, which is what we call over-the-counter or OTC transactions. These are usually transactions that happen on instruments which are not listed on an exchange, such as when trading derivatives. Derivatives are normally contracts created by specific brokers and then they are bought and sold only through the brokers, so they do not go through an exchange. The underlying assets, on the other hand, are the ones being bought and sold on the exchange. So there may be another transaction happening on the exchange simultaneously, but what we buy and sell is done as an OTC transaction. Brokers. Individuals can't usually have a direct link with the exchange, but rather they have to go through a broker. The broker has the link to the exchange and provides all the relevant information to the buyers and sellers in an easy to use way, so they can execute their transactions. The way brokers provide their service can be through different platforms such as phone apps, or their website, a dedicated computer trading platform, or a more conventional way through calling on the phone. To stay competitive, brokers can provide additional services to their clients, such as technical analysis tools, research reports, arbitrage ideas, or other perks to keep them from going elsewhere. We'll explain all these different tools individually at different points in the course, so you can decide which ones are suitable for you. Brokers get paid a commission on each transaction that goes through them, and the ways they charge for these vary. The conventional way has been that brokers charged a specific percentage of each trade as their commission. Some also charged a minimum amount for smaller transactions. Another, more recent way of brokers charging their clients is by what they call free trading, which actually means that you do not know how much you're paying for your transaction, but rather the broker takes the bids and asks, make the gap between them a bit wider, so when you place your transaction, they get the difference that they put between both sides. This difference between the bid and ask is also called the spread. How this works is that when you place your buy order, for example, and you can see that you can buy for $1, the actual price the broker will be buying at, which you cannot see, is maybe 99 or 98 cents. Once the order is placed, you pay the $1 and the broker gets their 1 cent or 2 cents immediately. This is why every trade you'll be placing will always start off by being loss-making, which is the same as if you placed the trade and paid an additional commission. We will get into more details of trading later, but I just wanted to explain how brokers work here first. Custodians. When you buy an investment and do not hold it in your hand, it is being placed for safekeeping at a custodian bank. In the past, or even at present, when shares were physical, custodian banks had large safes where they kept the physical shares in them. Currently, most of the traded assets in the financial markets are electronic, but they still have to be kept safely at a reliable place. So we have custodians who do this. A broker can be the custodian, but not always. Since custodians have to have rather strict financial requirements, smaller brokers might not have their own custody service, and the custody is then provided by another entity. Custody, like any other service, also has a charge that is paid. This could be included as part of the brokerage fees or charged separately, depending on many many factors and the agreement between the client and the providers of the services. Regulators. Regulators are agencies that have the goal of overseeing the different functions in the financial markets, ensuring fairness and transparency and preventing fraud. There may be several such agencies in a country overseeing different parts of the markets, but there would usually be one big agency to oversee them all. I won't go into all the details here, but we can look at two quick examples. In the US, the largest and most powerful financial regulator is the SEC. The SEC, which is short for Securities and Exchange Commission, regulates all financial institutions and financial markets in the country. By the way, securities is a comprehensive term that means anything we can trade in the financial markets. In the UK, the FCA, or the Financial Conduct Authority, is the financial regulator overseeing all financial institutions in the country. As an individual in markets, my interest in this is mainly to make sure that the broker I use is regulated by the relevant agency in my country or the countries I invest or trade in, to make sure that it is not a scam, as well as make sure that if any problems occur, I have rights. In order for the regulator to give a license to a broker or any financial institution, they have very specific and strict criteria about several factors, some of which include financial requirements as well as requirements for the staff in certain positions. Here is an actual real-life example, which is a screenshot of my own licenses from the FCA, which I had to have while working in different roles at a financial institution in London. Indices. An index is one of the main ways of measuring the health of the overall market, specific sectors, or some other specific attributes. Just a little side note that the plural of index in the financial markets can be seen as either indices or indexes, which are both used. Generally speaking, how an index works is that we bundle together specific instruments and their total value is what the index is worth. An index's name will usually include two elements, a name and a number. The name is the entity creating the measurement, while the number is how many items are included inside the index. Let's take a look at some examples to clarify indices. I'll start here with a simple one, which is the S&P 500. S&P is short for Standard & Poor's, which is a well-known credit rating agency, as I've mentioned earlier. In addition to providing credit ratings for countries and companies, they also create indices for people to use in their investment decisions. Their most famous index is the S&P 500, which includes the largest 500 publicly traded companies in the US. Well, kind of the largest, but let's just keep it at that for the purpose of this lesson. The way the index derives its value is that the largest company in the index gets the biggest weight in the measurement, followed by the next largest, and so on. This is what is called a market cap weighted index, which considers the market cap of each of the index constituents in the measurement of the index value. Another famous index, and when people talk about the US market, they still usually mean this index, is the Dow Jones Industrial Average, which is also known as the Dow 30 or US 30. As the name suggests, it includes 30 companies in it, but instead of just picking them by size, the criteria differs in that these 30 companies are picked according to how consistent and stable their earnings are. With this in mind, this is one reason some consider it to be a better reflection of the overall economy, since the companies in it usually don't have major changes in their projections and tend to fluctuate less than newer companies or companies in more volatile industries. The Dow Jones is also unique in the fact that it is not market cap weighted like most other indices, but it is price weighted. If you're interested in these differences, I suggest you try to look them up for further details about their calculations and the pros and cons for each. Two other main US indices are the Nasdaq 100 and the Russell 2000. The Nasdaq mainly consists of tech and high growth companies, while the Russell 2000 consists of smaller US companies. How we use indices is usually to gauge movements and sentiment in different sectors or segments. For example, when the Nasdaq is moving, this mainly reflects sentiment towards tech and high growth companies. Movement in the Dow Jones reflects the sentiment towards more stable value companies. Outside the US, some of the famous indices include the FTSE 100 in the UK, the DAX 30 in Germany, the CAC 40 in France, and the Nikkei 225 in Japan. The value of the index is normally expressed in the index's local currency. So, the value of an American index would be in US dollar, the German or the French would be in euros, and the Japanese in Japanese yen, and so on. We will talk later about ways to use index values and ways to trade them as well. I find it really important to understand the actual functions of the markets before participating in them. Again, in this course, I am introducing certain aspects of the financial markets briefly, but will go into details whenever there is a subject that is important for your actual investment or trading. So I suggest that if there is anything that you would like to know more about, please take notes and look them up later. In the next lesson, which I think is one of the most important lessons in this course, I will be talking about the different participants in the financial markets, with a special emphasis on explaining how institutions work and what they do. Some of this explanation will go into details about funds, so that you can understand more about how some of the largest participants in the markets, so that you can understand a bit more about how the largest participants in the markets function. See you next lesson.